Trump's rare earth stocks are about to skyrocket. Guys, right now something strange is happening. The stock market is at all-time highs, but people are losing their jobs. That doesn't usually happen together. And buried in that chaos is a handful of rare earth and mining stocks that no one is talking about. But I'm not a financial advisor. Some financial advisors might say to buy as much as possible before December 25th. By the end of this video, you'll understand what's really going on, why the market hasn't crashed yet, and what the most criminally undervalued names are, with emphasis on one stock, Cleveland Cliffs, ticker symbol CLF. Let's start with the facts. Right now, as I'm recording this, the stock market is almost as high as it's ever been. The Fed just lowered interest rates to 3.5%. Inflation is at 2.9%. But here's the weird part. Unemployment is at 4.6%, the highest it's been in 4 years. Think about that. The stock market is going up, but more people are losing their jobs. That's backwards. Now, I know people talk about Wall Street winning while Main Street fails, but is there not a world where both can win? Remember April 2025? The tariff lows, tariffs were crushing small businesses and the market. And when Trump called them off, the market rebounded. We lost $6.6 trillion in just 2 days with back-to-back 5% down days. If you had $10,000 invested, you lost $1,000 just like that. But within a few weeks, all that money came back. By June, the market was even higher than it was before the crash. When something crashes that hard and bounces back that quick, it tells us a once-in-a-decade opportunity is upon us. Now, the best opportunity is behind us. The majority of the run from April lows to highs, it was awesome. I mean, September was amazing. So why hasn't the market crashed yet? Well, there's two main reasons. The first is the Fed is propping up the market. The Fed is basically the parent of the U.S. economy. You can see that in the way Scott Bessent, the Treasury Secretary, talks. He's like a geriatric overlord. When he speaks, everyone listens. And he's not even part of the Fed. When Jerome Powell speaks, everyone listens and gets ready to buy or sell massive amounts of money. When things look bad, these two individuals step in to help. Everyone knows that Jerome Powell is the main guy. Bessent has definitely played a role in, for example, the tariff call-off, which led to that bounce. In the last few months, Jerome Powell has been the catalyst. The Fed has lowered interest rates 3 times. September, October, and November. And when rates go down, it becomes cheaper to borrow money. Companies can expand, people get cheaper mortgages and car loans. But here's the catch. The Fed is lowering rates because the economy is getting weaker, not stronger. They're lowering rates because unemployment is rising. It's like they're giving medicine to someone who's sick, as they should, not someone who's healthy. The second reason the market hasn't crashed yet is AI stocks are carrying the market. The S&P has 500 companies, but only 7 of them, including Nvidia and Microsoft, make up 30% of the gains. Look at the numbers. Palantir up 148% this year. Micron up over 100%. Nvidia is worth $5 trillion, more than most countries. These companies are priced like they're going to make profits forever. But what if they don't? What if AI doesn't grow as fast as everyone is saying it will? Another outcome is AI becomes commoditized, and these companies compete so hard that they have to offer what it was amazing AI's products 6 months ago for free. Check out Google Gemini. It's amazing and completely free. Why pay for ChatGPT when you can get Gemini for free? Let me be real with you. There are 3 major risks we're facing right now. Risk number 1 is stagflation. This is when inflation goes up and jobs go down. That's a recession. Right now we're seeing that. We're seeing higher prices. Inflation is at 2.9% and unemployment is rising. The last time the US had stagflation was in the 70s. The stock market dropped 50%. Are we seeing direct indicators that that's about to happen? No, but we want to be careful. The second risk is the AI bubble could pop. Bubbles always pop. The dot-com bubble popped in 2000. The housing bubble popped in 2008. Will the AI bubble pop? Nobody knows, but anything could trigger a pop, a bad earnings report from NVIDIA, regulation, or people just deciding that all this AI really isn't leading to the productivity that everyone says it is for. There's a third risk, and people aren't talking about this one. It's banking problems. Just 2 years ago, Silicon Valley Bank failed. That was a top 10 bank. The Fed hasn't indicated any major banking problems, but there are signs. Banks tightening lending, interest rates on bonds going really high, and banks merging or closing. Now there's two public figures who are trying to warn us or save us. Tom Lee has been going on a media tour with very specific predictions and an early sign warning for 2026. This is the guy that everyone trusts. When he speaks, people listen. He's been right time after time, and he's a bull almost all of the time. While the media screamed to sell in early 2025 into mid-2025, Tom Lee said to buy, and he was right. 2025 turned out to be an awesome year. Now he's issued a warning. Expect a 10 to 15% drawdown in early 2026. Why? Because Powell is still in power until May, and he's been hawkish for the last 3 years. That means he's going to try to fight inflation at all costs, even if it comes at the cost of the economy, aka the stock market going down some. So we're probably not going to get reduced rates to some unforeseen level. But Tom Lee says there are still two major factors that could save the market in the next few months. The first factor is a new Fed chair in May of 2026. In Tom Lee's words, this new Fed chair is going to come out in full force. And if the Fed does start cutting rates aggressively, the multiples on risk assets are going to soar. In other words, the small cap index is going to jump up a lot because those startup and mid-sized companies benefit the most from lowered rates. They get cheaper rates on their debt, and they use a lot of debt to borrow a lot of money to grow fast. $1 of revenue could be worth 4 to 5 times what it was pre-cuts. And these cuts, the benefits are going to spill over into the big companies too. The second factor is the White House. Trump is planning to implement pro-business regulation. We're already seeing legislation being passed that's favorable for manufacturing and mining. Just recently, there was a massive AI bill that favored cutting regulation and red tape to get all these data centers built. And here's what most people are missing. Data centers, AI infrastructure, electric vehicles, the electric grid, it all requires critical minerals and rare earths. America is dangerously dependent on foreign adversaries for these materials. The Trump administration knows this, and they're making American mining and manufacturing a priority. And there's a strange factor that could also help this Trump administration pro-business agenda. And that's the fact that Democrats could control the House. This would create a gridlock between Democrats and Republicans, which is actually perfect for the market. Markets love gridlock because it creates stability. No dramatic policy shifts like the tariffs, just smooth sailing ahead. Despite Tom Lee saying the market could pull back 10 to 15%, he says over the next 6 months, people are actually underestimating how bullish this market could become. While everyone is skeptical and sitting on the sidelines while the Fed change happens, there's going to be money just waiting to flow into the market. Markets tend to peak on good news when everyone's bullish, and they bottom on bad news when everyone's bearish. If everybody is skeptical who's left to sell, that's when the market goes up. Now, we're not anywhere near that bottom yet, but think of the bottoms we've experienced. Investors have been through a handful of major geopolitical shifts in the last 4 years. Think COVID, supply chain chaos, the fastest rate cuts in history, plus tariffs. All of this has made investors understandably nervous. But Tom Lee says today looks nothing like the 90s or the 2007-8 bubble. There's a lot of skepticism, but he says that's the setup he likes to see. He specifically called out a few sectors that are criminally undervalued. The first is small caps. Real earnings growth is coming, but he says the amount of money in small caps is not anywhere near what it ought to be. The second sector he's calling attention to is broadly banks. He thinks banks are becoming technology companies through AI. Think Goldman Sachs, Morgan Stanley. They're trading about a 10 price to earnings, but they ought to be more at a 30 price to earnings, according to Tom Lee. But here's what's even more interesting, in my view, manufacturing and mining stocks. These are the critical picks and shovels that make the AI revolution actually happen. The first stock is CLF, Cleveland-Cliffs. This is the rare earth stock nobody's watching. CLF is a major American mining and steel producer. But more importantly, they're positioned right at the crossroads of huge trends. Number one, there's the American AI infrastructure build-out. There's the domestic manufacturing boom, a renaissance. There's the critical minerals supply chain. All this is being built up in America for America. Not to mention increased defense spending domestically, as well as the ramp up of these mines in the US. Looking at the technical setup, CLF is forming a beautiful base. It's not moving much yet, which means you can get in now with low risk for high reward. It's slowly but surely been building out a flag pattern, the perfect pattern for a breakout. Now here's why CLF is special. They're a direct Trump policy beneficiary. They succeed when Trump moves for mining domestic national security. Not only does Trump want American manufacturing to occur, which helps build out these mines, he also wants data centers to be built out, and those data center components require domestically sourced rare earths. And while AI stocks trade at nosebleed valuations, Tom Lee has noticed that these mining stocks are undervalued and also under talked about, in my opinion. You're getting in before the crowd realizes what's happening. Mining and minerals are criminally undervalued. While everyone's still talking about Nvidia and AMD, no one's talking about Cleveland-Cliffs. Have you even heard of Cleveland-Cliffs before this video? I will be straight with you. Don't put all your eggs in one basket. Knowledge is power, and the biggest advantage rich people have is they know not to go all in. You have to diversify your holdings. If all your money is in tech or AI stocks, you're taking too much risk. Have some money in different buckets. Mining, banking, even some defense stocks. If the AI bubble pops, you'll be ready. Keep some cash reserves as well. Not to stay on the sidelines forever, but to have it as an emergency fund in case the drawdown Tom Lee is predicting happens. When the market pulls back 10 to 15% in early 2026, you'll be ready. It could be a major buying opportunity for sectors that have multiple tailwinds. Talking about manufacturing boom, the critical rare earth and minerals renaissance domestically, and the Fed getting aggressive as that Fed chair transition happens. Beyond CLF, there are 5 more names I think are worth watching right now to diversify. They have serious volume at a time when a lot of stocks simply don't right now. The first one is Carnival Cruise Lines, ticker symbol CCL. This is the poster child right now. They just had a massive earnings reaction and the technical setup is beautiful. Great strength in the close of the candle, reminiscent of Micron just a few days ago. Just like Micron had a huge green day after its first earnings close, Carnival Cruise could have a huge green day on Monday or later in the week. The cruise sector, including Viking and Norwegian, is showing strength, and airlines are also strong. Birds of a feather fly together. The second stock is Capital One. This is a financials play that's benefiting from Tom Lee's statement that multiples on banks are undervalued right now. If banks deserve tech multiples, Capital One is seriously undervalued. They recently had a green day followed by a red day followed by a tiny green day, which is called an inside day, meaning the chart is very tight, which is favorable for risk reward. The pattern is actually reminiscent of Palantir earlier this week, which had an equally strong setup. When there's strength after some weakness, you can get serious continuation. This is one to watch closely. Another stock to watch is Robinhood, ticker symbol HOOD. A lot of stocks have gone up in the past few months, but Robinhood right now is sitting just above a key shelf level, presenting another favorable risk-reward opportunity. It's holding important support and could go up from here. Another stock to watch is ticker symbol EAT. EAT is a restaurant sector name and it's building out a flag formation. It's not an AI name, so it's true diversification away from the bubble risk. Keep an eye on this one as that flag pattern develops. The final stock to watch is DAL, Delta Airlines. Airlines are benefiting from economic strength in the sector, as well as the boom in cruise lines. It could pull back a little based on where it is right now, or it could just go. These moves can run for several days at a time, so you're not too late. The most important name to focus on is CLF. Mining and minerals is where the money is. It's what the charts suggest, and it's what Trump's policy has been talking about. But these 5 names, CCL, COF, EAT, DAL, and HOOD, present diversification away from simply CLF. With these 6 stocks, you're well positioned to diversify and benefit even if the market pulls back. The reality is we're in a strange situation with the market near all-time highs even as unemployment rises. The Fed is propping the market up and AI stocks are carrying the load. This won't last forever. Stagflation is a real risk, and the AI bubble could pop at any moment. Banking problems are lurking in the background. The US government spends $2 trillion more than it brings in every year. There's risk, but there's also opportunity. Tom Lee, who's been right 16 years in a row, is expecting a pullback of 10 to 15% in the beginning of 2026. But that's not the end of the road. That's the beginning of a buying opportunity. The Fed is coming out in full force in May of 2026. The White House policies supporting American manufacturing and mining will begin to lift the market. And the wall of skepticism right now, due to massively high AI valuations, means there's going to be money sitting on the sidelines. The first half of 2026 might be rough. Tom Lee is saying so. I'm even saying so. But with names that are in these key sectors, mining, banks, even fintechs like Robinhood, you can still experience growth without being exposed to these massive AI names, even if they drag the market down. If we do experience a correction in the next couple months, don't panic sell at the bottom. We've all been that guy. Don't be that guy. Be the person who understands what's happening. Be the person who has dry powder, who's ready to hop in when there's blood in the streets, and who understands the sectors that can benefit even if AI stocks are no longer the move. You are now more prepared than 90% of investors. You understand the risks heading into 2026. You understand the opportunity, and you understand the sectors poised to benefit. What's your take? Are rare earth and mining stocks about to have their moment? Let me know in the comments below. And as always, I'm not a financial advisor. Do your own research, do your own due diligence, and take a look at these names. Look them up yourself. The drawdown is coming. The opportunity is here. The question is, will you be ready? Hit that subscribe button to catch the next warning. And head over to stockscommunity.com to join the #1 Discord for busy investors. I'll see you in the next one.